Spreadsheet Guide version 2. So the spreadsheet's a year old, nearly coming up to, and it's had some new additions that would happen naturally over time. And the last video that I made hasn't got the new additions, particularly these ones down here, the really powerful ones that I've included, the new ones. This video will be multi-parts because it is a huge spreadsheet. So this is just going to be part one, which I'll talk about the main tab. And so what you'll see when you first launch the website, the spreadsheet, is the main tab where we have the signals at a high level. Now we have the USD yen. Okay, so this was a buy. So you'd question why is that a buy? Well, first of all, it checks this start of the day. Was it a buy? Yes or no? It then checks the current ratio. Is it a buy or a sell? You know, it's a buy. The shifting across time is a buy. So it's like check, 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 buy. Now, what I want you to do is not to trust it completely, because don't forget there is a margin of error. The retail aren't always wrong, they're often wrong. Okay, and that's really, really important to note. Just because it says true buy, you have to remember there's like a 20% margin of error, and you'd always want to do technical analysis with risk management. You wouldn't just launch into the dollar yen and buy blindly just because of this, okay? And so what is interesting, you'll find over time, is that the shifting across time reflects actually on the price performance. So when they sell it, okay, so they sold these, price comes up, you see, and when they buy it, price comes down. So it proves how the market is negatively correlated to retail sentiment. Greens here, greens here. Okay, now we've got the Kiwi. They went long, look what happened to price. And then they went long yen, look what happened to price. So it proves it works, it's negatively correlated price with retail sentiment. And that just shows that the average retailer does get screwed very, very often. It's based on what the majority are doing. So we'd want to do the opposite of the majority in order to succeed and be profitable. So I've taken you through how the shifting across time is measured, real-time data and snapshot data, and then that's your difference, okay? And that's your shifting. So that's that. So the negative neutral zone crossover signal. So what this is, when it crosses the 50% line, in order to divide the majority and the minority. So this tells us an impending price change is on the horizon. So we'd look to potentially buy the Australian dollar Kiwi, not now because it's just crossing over the 50% line. And this might be the first time you've seen the currency basket bubbles as well. So I have made a video on this and how it works. I've even talked about the psychology of it. What it is really is that the retail hold on to losses and they cut their winners short. Okay, that's the premise behind everything. Is that they make really bad trading decisions. That's why we want to do the opposite of the majority. And so when they go long, they would want to sell, and this is them going long. Okay, they bought the Kiwi and they bought the yen today, so we'd sell those two. And now they're selling the euro and the pound, so we'd buy it. And that's what happens here, you see. If it comes here, it's a buy. If it comes there, it's a sell. This is all mixed. That's mixed. So if you were looking for a trade, you'd probably look for a long pound and a short Kiwi, or maybe a long euro and a short yen. Okay, so just looking for that box, that rectangle, buy, that rectangle, sell. So you just want to do the opposite of the retail. Currency baskets, so they're your, the baskets, and then the USD pairs, dollar yen's a buy, yen pairs, commodities, So that's just the data. This currency basket stuff is from this. So that's where that data comes from. This updates in real time. Live prices. Now it says live prices, but there is a small delay there. It's a 50-minute delay, but it's okay, you know. FX volatility. Now, the reason I've included this is just so you're aware of how to adjust your position size. So, I don't know, let's say, for example, you used to trade in the cable rate, the pound USD. If you went on to say you want to trade the, I don't know, the pound Kiwi, you'd use half the lot sizes you're used to, because you see how the difference in the pips on the day. So you use half. Say if you were using, I don't know, 0.2 lot size, you didn't use 0.1 for that one, just because of the volatility is twice as great. And you see how the volatility is still high on the pound on a day. Yeah, it's nearly 1% on each pair, so it's still highly volatile as a pound. We're going up to the election soon in next month, so that's something to be looking out for. Just wrapping up the first part of the video now is the pivot points, where these are your invalidation, validation, line in the sand levels. So, for example, let's say you're trading the pound USD and you were intrigued whether or not it was a buy or a sell on the day. Well, you just look at your pivot point. Now, if price is above, then it has a bullish bias, and then you target that resistance. Okay. And if it's above resistance 1, then you target that. If it's above resistance 2, then you target that. Okay, so it's just a case of where you target. And now if it falls below pivot, then you target that. You know, I don't really need to go on about it, but say if you were to sell a pivot and you targeted that, that would be your stop loss. Okay? And say if you were selling at support 1 and you targeted that, that would be your stop loss. So we'd always want to try and have tight stop losses and big gains. So just trade opportunities really. And you see that you know that the Kiwi dollar was a sell, so you maybe look for the Kiwi USD, just somewhere here. There it is. So there's your pivot, there's your line in the sand. Breaks below 6431, you target 6404. Okay, and that's how you make your pips. Just tight stops, and you just get out at the pivot. If it goes wrong, just get out. You know, don't hold on to losses, and let your winners ride. And just to top up the part 1 of the main tab is your very high level monthly pivot point. Whether or not a currency pair that you're interested in, you're looking at, is above or below. Now, don't forget we just started November, so at the moment the Kiwi USD is above the monthly pivot point, and there's your live price. Okay, so that's your bias, I guess you could say. If it's below, you know, it's quite a strong technical bias. If it's above, it's a strong technical bias. And this is a link to a document that I've made. I think it's about maybe 2 years worth of sentiment data. So that's worth looking at whenever you have some free time, just to get an overview of the major FX pairs. It doesn't do any minor FX or commodities. So that's worth clicking and checking out. And that's your first tab. So it's going to be a super long series of videos, but that's your main one. And I've explained to you how the currency baskets work and how price is negatively correlated to retail positioning. It's quite cruel, but it's effective. So just make sure you're on the right side and you'll always be okay, and have good risk management. You know, there's nothing worse than holding on to losses and then hoping it will turn around. Hope is like the worst indicator. And if you use that pivot system, then that's great. You know, even if it takes a few times, a couple of attempts, if you get stopped out at 10 pips, it's fine. You know, what you don't want is to get stopped out at 200 pips. So that's why you'd use this as your line in the sand. I use the daily pivots a lot, weekly pivots and monthly pivots too. So that's your main tab. There's a hell of a lot on this spreadsheet, so this is just part one. I'll talk about the stop loss clusters next. Okay, stay tuned.